What's up everyone, welcome back to my channel. This is Engineering Options and today is January 11th and I would like to start with week 1 of my portfolio review. So let's get into it. So my total portfolio at this stage sits at around 53k. I have about 15 positions open using my different strategies. If you don't know about my strategies, check out the video on the description below where I go in detail into them. But in general, there are 3 buckets: volatility-based strategies, semi-directional that have both a directional component and a volatility component, and directional strategies, mainly ratio call diagonals. I have a video also on the description where I break down some examples and the management I do with these ratio call diagonals. So today I will go into the adjustments on the open positions for this week and the top setups that I have for next week. So regarding the market status on an overview, the VIX is still really low. It's hovering around 14. This is almost all-time lows. It has spiked up a little bit with the Venezuela situation, but after a small spike, it seems the market did not care much about it. In reality, the SPY and the Russell 2000 both made all-time highs on Friday. If we look at this by sectors, we had most of the sectors performing really well, with consumer discretionary and materials performing almost 5% in the last 5 days. Utilities is clearly the loser out of this sector. I like to look at the sectors because it gives me an idea where to put my directional focus. I want to pick the sectors that are performing well, not the sectors that are underperforming. Regarding my open positions, I currently have a bunch of positions open, as you can see. I will go into details into some of them that I'm looking to manage, and there will be details on every position in the Substack in my newsletter. Here I'll try to keep the video at a reasonable length, so I'll just focus on a couple of them and why I'm managing them. The first one I want to talk about is EQT. EQT, I opened a couple of weeks ago a short strangle about 50 days to expiration, 50 to 62 and a halves. At the time, that was about a 16 delta on both sides, and the price has come down a little bit. I opened it was about $55. It's now hovering around $51. It's still well within the strikes. However, if we look at the delta, you can see now that the put has a delta of 40, but the call only has a delta of 7. So that position leaves me quite positive delta, meaning that I make a lot more profit if the price goes up. This is part of my strategy 1, where I'm mostly playing volatility, not a directional bias. So I do not want to have a position with such a strong directional bias. So usually when my total delta of the position surpasses 30, I try to cut it in half. So I'll be looking to buy back the 62 and a halves and sell probably a 55 put to cut my deltas in about half, so that the idea that I collect more premium and I cut my deltas. Second adjustment that I'm looking at is in my TQQQ covered strangle position. This is a little bit a complex strategy, so be sure to read the newsletter if you are not aware how this works. But essentially, I'm having 200 shares of this position at this stage. These have a basis of 52.8. So I currently have both one call and one put against my shares, and these are expiring next Friday. So this is just a normal rule for me. Whenever they get into 1 week before expiration in this type of position, I always try to roll out. We are at about 5 days to expiration, so I think it's a good time to roll out. Current price is sitting around $55, so none of the strikes are being breached. So this is a hefty profit on both sides, and I can easily sell a 30 delta on both sides, both the short call and the short put, to try to collect more premium on this position. So the last adjustment I want to talk about is FCX. FCX is a material company. With the recent rally in gold and silver, it has been making a hefty profit. I opened my initial position around the end of December, marked here in the circle. You can see the position then stagnated for a little bit, and then it recently broke out and has been rallying. I have moved up my stop to about a 53 handle. The problem is that my short calls are at 55. You can see the recent price is above 55, so I'm trying to roll out this short call to be able to capture more profit upside. Let me show you an example. So let me show you how I would trade this. We have 2 times the 55s, so those are already with a 0.7 delta, 5 days to expiration, and that trading for about $2.10, as you can see here. I would try to roll those out for a credit and at the same time unlock more profit potential. So if we look to buy this back, and if we try to sell, we can see that we can roll to the January 30th, the 56, or we can roll to February 6th, the 57th. I think that we can capture here about $40 to $50 in credit, but most importantly, we are moving a 55 to a 57. Moving a 55 to a 57 means we're unlocking $200 in profit. Since I have 2 of them, we're unlocking $400 in profit, meaning if the stock is above 57 by February 6th, we can get much more profit potential compared if we had just the 55s and just collecting this credit. So that's how I try to roll this ratio called diagonals, always up and out, trying to minimize the delta on the short calls, but while trying to collect the credit and keeping my theta always positive so that the passage of time, if the price of the underlying does not move, just brings me in a small extra credit. Okay, so looking into the positions for the next week, what am I looking at? In terms of lowlights, I have HIMS as a big lowlight, and I'm going to be looking to enter a standard ratio put diagonal in HIMS. If you don't know how I trade this, look out the video in the description. I explain in detail how I trade the ratio call and the ratio put diagonals. So HIMS is a perfect candidate because you can see the recent price movement has just been down. The momentum is totally down, and it seems Amazon and other online suppliers have also been starting to sell the weight loss drugs. In this situation, HIMS does not have any moat, they do not have any advantage, and from a technical standpoint, this is a total sell, and from a fundamental standpoint, HIMS also does not seem to have any moat. So I'm going to bet that HIMS will go down here. RGTI and SMCI are 2 a little bit similar situations of stocks that even with the recent rally in AI related stocks could not get any higher. At the moment, I'm not opening any position on them, but it's something that I have on my watch list as a potential down move for the future. On the other hand, for highlights, I'm going to be playing CCL, so that's Carnival Cruise. So Carnival Cruise had a big rally after this earnings on December 19th. Then it stabilized and now it rallied back up and is close to these highs. What I'm seeing here is what I call this a breakout type 2. So I have my breakout 1, that's just when the stock is rallying and just surpasses. And our breakout 2, the price rallies up and comes back down close to the moving average and then tries to rally up again. That's what I think as a breakout 2. I like these setups because they give a good risk to reward here. We can put a stop loss at about 30.5 that invalidates our position, and we have a good margin to run if things go in our favor. Other positions I will be looking at is Amazon and Intel. They have a good run this week, but they have earnings coming in really soon, so I will just be monitoring how these stocks perform and mostly how do they behave around earnings. Due to my limited capital, I cannot open a lot of parallel position. Mainly, I cannot have a ton of directional positions in parallel, but still, I like to monitor positions in my paper trading. I will be keeping these out and I will be monitoring them, and in my newsletter I will detail also how I'm managing these positions. It's just a way for me to gather more data and to validate my strategy quicker. Some of these positions that I'll be monitoring is this SOXL, an ETF 3 times daily semiconductor bull. Essentially, this is a pure breakout play. I have APLD that we also see a post-earnings announcement breakout play. We have RKT that is also a breakout play. And KTOS is once more, it had a huge rally on positive news due to the defense contract. So this is something that is news driven. I like this type of plays on a news driven situation. I would put my stop somewhere around 104, around here. If it drops below, I would close for a loss, but otherwise this has a huge potential for rallying as a small cap stock. In terms of volatility positions, I wasn't able to find outstanding positions now with earnings season just starting, and like I explained, with the VIX at a really low level, it's hard to find great positions, but I still was able to find something that caught my eye. One of them is JD, a Chinese stock. JD has been moving around a very small price range around the 29 handle for now about 2 months. You can see that implied volatility has come up a little bit, but the realized 30 days volatility is still relatively low. The 10-day volatility has been increasing. However, it's increasing on a very small price range. So the price goes up and down, but it seems very range bound. So I find this an interesting position. If we look at it 40 days out for February 20th, we can see that if we look at the 16 deltas and about here to be 18 delta, we can get about a 2% on the position. So 1% on the call, 1% on the put side. So that's pretty interesting for me. I think this is a good position to start. Another one that I'm looking at is USO. USO implied volatility has come up significantly due to the Venezuela situation. However, price has not followed it. So this is a bet essentially for the status quo, for things to stay as they are and not expecting any further escalation. One thing I like about USO is that if we look at the February 20th, 40 days out, we can get the 81s and the 64. We can look to make about 2 to 2.5%. And 81 to 64 is really a wide price range. If we look at the past almost 1 year, you can see that the price has almost always been within that range. So I think that gives us a wide margin of safety for this short strangle. The last position I would like to talk about is on the short put side. I don't have any short put out, so I was trying to find a suitable position. Something I found interesting is EOS Energy. EOS Energy is a stock that has rallied a lot over the last fall and now has stabilized. I usually like this type of price movements for my short put strategy. It's easy to put a stop loss somewhere around this 12 handle. If it drops below, I will close for a loss. But as long as the stock hovers around the values that it's been at, we can get a pretty decent profit. You can also see that IV has stayed elevated, but realized volatility both at 30-day and the 10-day level have been coming down significantly, and at this moment we have a IV to HV ratio pretty favorable to sell options. I'll be looking to sell a $14 put on the 30th of January, about 20 days out. It has about a 30 delta. I expect we can sell it for about $70 to $75 on a $1,400 of cash secure. That's a pretty good rate of return for about 20 days of exposure. So those are my positions and my adjustments that I'm looking to make for next week. I try to keep it simple and just go over my higher conviction positions. I will go into more details in the Substack, so make sure to register for my newsletter. Please subscribe and hit the like button. Thank you guys.